Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to Money Talk at the start of the new business week. It's Monday the 10th of August. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 100 million customers across 13 countries. In today's business and finance headlines, Iran has set out sweeping conditions for reopening the Strait of Hormuz, demanding that the US permanently end its war against the Islamic Republic, lift its naval blockade and sanctions, withdraw military forces from the region, pay war reparations, and release frozen Iranian assets. The ultimatum, delivered Saturday by Iran's top security official, came just hours after Abu Dhabi's state oil company said one of its tankers was targeted by a missile while transiting the Straits. US employers unexpectedly cut jobs in July, and hiring in the prior 2 months was revised lower, suggesting the labour market is weaker than previously thought after surprising strength earlier this year. Non-farm payrolls fell by 23,000 in July, and the unemployment rate edged lower to 4.1%, but that was due largely to a further decline in those holding jobs or looking for work. Wage growth slowed as well, with the 12-month increase in average hourly earnings slipping to 3.2%, the lowest since May 2021. China's exports surged almost 24% year-on-year, the second consecutive month of 20% plus growth. Exports of chips soared 117% and computers by 67%, while overseas sales of electric vehicles, ships and general machinery also posted strong gains. China's trade surplus now stands at $687 billion for January to July, putting it on track to surpass last year's record. The Philippines economy suffered a sharp loss of momentum in the second quarter, with GDP expanding just 2.3% year-on-year, far below expectations and marking the slowest pace since 2009 outside the pandemic. Consumer spending, the backbone of the economy, grew only 2.8%, its weakest rate in more than a decade, while investment contracted 9.2%. The downturn has been compounded by the inflationary shock from the Iran conflict, which pushed up food and fuel prices and disrupted remittances from overseas Filipino workers. On the show today with their insights and analysis are Alex Wong, Director at Alex K.Y. Wong Asset Management, and John Schofield, Managing Director of Tempus Investment, providing a view from Mainland China. It's Shanghai-based independent economist Andy Scher. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, a sharp slowdown in the US jobs market drove stocks higher Friday. The S&P 500 advanced 0.6% for a record close of 7,758. The Nasdaq Composite outperformed, climbing 1.3% to 26,691. The Dow added 152 points, or 0.33%, to end at 54,037. Stocks posted a second straight week of gains. The S&P 500 advanced 3.6% in the period. The Nasdaq saw a gain of 5.2% thanks to a bounce back in chip stocks, and the Dow gained 3% during the week. All three indices notched their best weekly performances since April. Treasury yields fell Friday after the jobs data dimmed the immediate outlook for higher Fed interest rates. The yield on the 10-year US Treasury note fell 3 basis points to 4.65%, and the yield on the 2-year Treasury slipped 4 basis points to 4.2% and hit the lowest since July the 17th. In the currency markets, the dollar index fell 0.4% to 99.6 on Friday, near a 2-month low. For the week, the US dollar index fell 0.2%. The Japanese yen surrendered nearly half of its intervention-driven gains last week. The Japanese currency was trading about 157.75 yen per dollar Friday. And the offshore Chinese yuan held firm around 6.74 renminbi per dollar on Friday, remaining at its strongest level since early February 2023. Gold reached a 2-month high and notched its best week since January. Spot gold settled 2.3% higher at $4,342 per ounce and was up 7.3% last week. Brent crude oil rose 1.3% to $83.55 a barrel after reports that Iran will seek to restrict US and Israeli ships from the Strait of Hormuz. Last week, Brent fell 5%. And Bitcoin was last seen trading at $65,000. Last week, the cryptocurrency rose 3%. Asia-Pacific markets closed mixed Friday amid uncertainty over the reopening of the Strait of Hormuz to shipping. Japan's Nikkei 225 closed 0.1% lower at 65,607. For the week, however, it gained 1.9%. South Korea's Kospi fell 0.6% to 6,259 in choppy trading. Last week, the Kospi fell 5.1%, taking the decline from its June high to over 31%. Hong Kong's Hang Seng Index was up 138 points, or 0.5%, at 25,668. Last week, the city's benchmark index fell 0.8%. And mainland China's CSI 300 closed 0.9% higher at 4,694 for a weekly advance of 2.3%. Futures markets indicating a flat open for the Hang Seng in Hong Kong this morning, but looks like the Nikkei 225 in Japan will advance 0.9% when trading gets going.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Monday morning guests. We have with us this morning Alex Wong, Director of Alex K.Y. Wong Asset Management. Morning, Alex.
Hi, morning, Peter.
And also joining us this morning from Hong Kong is John Schofield, who is Managing Director of Tempus Investment. Good morning to you, John.
Yes, hello. Good morning, Peter.
Now, let's start with the US jobs data. Non-farm payrolls fell by 23,000 in July amid a drop of 53,000 government jobs and softness in retail, leisure and hospitality. The Dow Jones consensus forecast had been looking for a gain of 83,000. And in addition to the weak numbers for June and July, the final count for May was revised down to 63,000, and the revised numbers brought the 12-month average down to just 34,000 jobs. The unemployment rate edged lower to 4.1%, but that was due largely to a further decline in those holding jobs or looking for work, and the labour force participation rate fell to 61.4%. That's its lowest in more than 5 years. And outside of the COVID era, the participation rate is at its lowest since the middle part of 1976. And average hourly earnings slipped to 3.2%. That's the lowest since May 2021. Alex, is this good or is it bad? I mean, the payroll declined 23,000 jobs. Not so good, is it? But then the unemployment rate, 4.1%. That sounds pretty good.
Oh, that is because of less people searching job only. So overall, it is bad, I think. Because this time, actually, we should include the impact from the World Cup. And especially, I think a weakness in hospitality is very concerning because the World Cup actually should be positive for those areas. So I think the Donald Trump policies actually has dampened the tourism industry in the US a lot. So, and that probably would be hard to recover. So I think overall, actually, the outlook is quite bad.
Do we need, or does the US need, as many jobs to be created as it used to in the past? We have been used to quite high job creation, haven't we? But that has certainly been slowing in recent months, maybe more than in a year now. And is that because there are structural changes going on in the US that means that in order to provide jobs, we just don't need to create as many as before?
Yeah, right. I think that's a key structural change. And for the whole economy, actually, employment may not be that important as before, because there would be a lot of AI-aided work. So for the whole productivity concern, that I think is okay. But for those people who are less skilled or difficult to transform their skill set, then probably that would be a super bad news. So, and also that would be bad for consumption for the lower end market. So that depends on your angle. I think for the macro angle, it is okay. It's a new norm now. But for those people who are in the suffered area, then they probably would be very difficult to turn around.
John, how do you read this? Good or bad or mixed?
I would say certainly mixed, mixed to bad. Yeah, clearly there are a lot of, there are a lot of different factors at work here. Not least the AI coming through, inflation, and so on. But the data seems to be, it's been like this, pretty much like this for the last couple of years, I think. Slow growth, or whether 1 month's figures, are really part of the trend or not, or we're just sort of bubbling along with employment. That remains to be seen.
I mean,
Obviously,
sorry, carry on, John.
yes. I mean, the administration, obviously, and the Fed are probably factoring this in. It gives them further excuses not to raise interest rates.
Where are all the workers going? Because the participation rate is now 61.4. It's down 0.7 percentage points just this year alone. 101.4 million people have dropped out of the workforce. Where are they going?
Yes, I mean there are a lot of jobs that don't, or people earning money from influencing and things like this online, which may not appear in the kind of official statistics if they're not under formal contracts of employment.
Because I mean, that's what I hear. I hear there are a lot of people. I suppose I count as one of them, actually, who's not looking for a traditional job. At the same time, I am doing things for myself online using AI and other sort of tools. But that I don't really count as being part of the workforce. I presume there are a lot of people like that these days, particularly maybe younger people.
Yes, I believe so. Yes, it depends. I don't know. Would you appear in the statistics as an employed person or not?
I don't think I would. I wouldn't.
Actually, that brings me to another point, though. That have been some question marks since Doge. About how good the statistics are.
Yeah,
they're being collected not only in the States but also places like the UK.
Because people like us, when we're not working, we're not looking for jobs, but we're not sitting there doing nothing either.
Yes, exactly. But where do you appear, and where are you on the government's radar screen?
Yeah, maybe not at all, hopefully. Alex, the unemployment rate, 4.1%. I mean, that is pretty good, isn't it? I mean, you don't normally get the unemployment rate dropping much below 4%. So is that something that policymakers are going to have to take into account? Because that's a sign that the labour market is actually quite stable, isn't it?
Well, I think this is because of the low participation rate. So I think they will take it into account of both. So it sounds good, but this is mainly due to people not searching for the traditional jobs only. So it is still question mark, I think, because those people probably are influencers or just speculators in the market. But anyway, they are not looking for jobs, and that distorts the figures a lot.
Yeah. I mean, some analysts have called the job market, described it as being low hire, low fire. Do you think that's right, that both hiring and firing at the same time, unusually, are both depressed?
Yeah, right. Because it is difficult to train, and I think that is a high cost in firing here, because you have to put a lot of training costs again. And I think when they get the structure slim, then probably they will stop flying too much. So that's why the flying is also low. But for hiring, I think that there's a lot of jobs are being replaced by AI or machines. So that is why we are not seeing too much hiring as well.
Yeah, because it looks like, doesn't it, that all the data is showing maybe quite a sharp slowdown in hiring. If you look at the ADP numbers that came out last week as well, private sector hiring was slowed quite sharply there as well. There does seem to be very much a low hire sort of mentality in place at the moment.
Yeah, because AI actually improved the productivity a lot. So one people probably can do two people jobs now. So that's why people probably would stop hiring too much. And so that is the impact. I think that is the new reality we have to face.
John, how much of this is due to the Iran war and rising prices, rising cost of living? Is that a fundamental aspect of why we're seeing this sort of weak hiring environment?
Yeah, I think you can factor these things in just as much. Of course, the growth area in sort of military or military equipment manufacturing is a positive factor, I guess. But yeah, people will be cutting back on. In the States, obviously cutting back on gasoline and things like that. So they'll be moving around less. If it costs them more to travel to the next town for a job or so on, they may be less likely to do that.
So putting this all together, what does it mean for the Fed when it meets next month? If we look at Fed fund futures markets, the chances of a rate cut now in September are just 40%. But the CME's Fed Watch tool does see a 55% chance of a hike in October and an almost 75% chance in December. So it looks like, according to the futures markets, just putting off maybe by about a month or so the rate hike, but it is coming. What do you think?
I think they will do everything they can to continue this kicking the can down the road, talking the Fed, but whether they're able to, obviously the pressure is now growing. We saw 3 dissenters, I think, to the who wanted to hike this time. That they are the more independent members of the board as well, not those necessarily under, however subtle the political influence is, and so on. Meanwhile, the battle with the bond yields are okay. They dipped a little bit late last week, but bond yields seem to be on a fairly steady uptrend. And as long as inflation doesn't is stuck around this 3% level. We've now been there for 5 years, and the voices are getting louder to do something about it.
It's hard for Kevin Walsh to say on the one hand, he has zero tolerance for high inflation, but then as you say, inflation's been well above target for 5 years now. It sort of begs the question, well, okay, what are you going to do about it?
Yeah, exactly. That's why the dollar dipped quite sharply after this non conference, press conference, where he didn't say anything at all about how he's going to tackle it, except to use the excuse that because bond yields are rising, that was partly doing the Fed's job for it. But I
that's a cop out, isn't it?
I think it's I think it's the other way around, actually. I think the more bond yields go up, and therefore the interest bill rises, and therefore the debt rises, that the worse it becomes.
Yeah. Alex, what are your thoughts about what is the Fed going to do in September?
I think it will stay hold because we have just a weak set of employment data, so that is a very good excuse to put on hold. And that would depend a lot on the inflation picture. But the problem for the Fed is many of those factors probably are not too interest rate sensitive. So the Fed actually may not be able to do anything on controlling the inflation, because the rate hike probably may not be too effective these days.
Is there a risk that if the Fed doesn't do anything in September, it might be forced to hike rates just before the midterm elections, which will be clearly not what Donald Trump wants?
So that probably make them delay again if we will see continued deterioration in the job data. I think they would put a lot of emphasis on the excuses that make them to put on hold.
So then that means that they're not going to raise rates in October because that's too close to the election. So if they don't do it in September, their only chance then is to go in December, just before the end of the year.
But the variable is still the coming CPI. I think if we have a surpassingly high CPI, then I think they would do the rate hike. So even though, as I've said, I don't think the factors are now too interest rate sensitive. But if the data that are surprisingly high, then I think they probably would do it. But my guess is they won't.
Yeah. Okay, well, look, we've got some more data to talk about from China. China's exports jumped 24% in July, the second consecutive month of 20 plus growth. Exports of chips soared 117%, computers soared 67%. The trade surplus was $102.5 billion last month. It's on track this year to go and beat last year's record. I mean, John, what do you make of this? I mean, it is now China has a trade surplus in almost every single sector. Now, the only thing it hasn't had a trade surplus on is semiconductors, but it's catching up fast on that as well. I mean, this causes surely problems globally, doesn't it, for trade?
Yes, clearly. It's quite astonishing, really, how the momentum has just continued to build on the manufacturing side and the export side. And, it's out and out mercantilism. Europe in particular is really, really the situation is really concerning for their domestic industries, particularly in Germany, as we've seen. We're getting sort of some political noises and so on, and I see that China is saying, "Oh, they want balanced growth," but we've been talking like this for years about how China should needs to support domestic consumption. Therefore, it will bring in more imports. I see the imports are also rising, but they're probably inputs as much as anything to the export drive and on energy and so on. So I don't know what's this, but I don't know what's going to bring this, to a head as a political crisis. And how Europe and the US seem to sort of more or less backed off for now, and Europe is sort of talking amongst themselves of the EU as whether they should hike tariffs on China, things like that.
I mean, what do you make of this, Alex? The trade surplus now for January to July, $687 billion. It's going to, at this rate, it's going to exceed last year's trade surplus, which then was a record as well. And it just seems that every single sector is booming, doesn't it? I mean, semiconductor exports up 120%. I mean, this is clearly great for China. Well, maybe is it great for China, but it's a big strain on the global trading system, isn't it? Because the whole idea is you trade comparative advantages. I'm good at this, so I'll sell you that, and you're good at this, and I'll buy that from you. But at the moment, it's all China selling everything and not buying very much.
Well, I think it's because the AI demand actually is surprisingly strong. So they put the geopolitical concern aside, so they could source anything from anywhere. So, and China actually is still having the strongest manufacturing base. So I think that's why we are seeing this surge in China export, because people are grabbing every probably things that they could get to for building AI system. So even Apple are trying to source from China. So I think there's the trying to source memory from China. So I think that is why we are seeing so strong performance in China export.
And where does this all end? There's going to be for sure repercussions, aren't there? That particularly from Europe with their concerns about the auto sector, but the US as well. Surely it's not possible for this to continue like this.
That's will take time. I think if we are talking about a strong demand side, then probably the demand side may not change too much in the short term. And the supply side as well, I think. This is very difficult to relocate the supply chain. So in the meantime, I think that would be very difficult to end. So probably we'll see some administrative measures like a tariff. But in the next 2-3 years, I think we probably may still see this kind of a trend to continue, because right now we probably are in the history of historic infrastructure building. So I think that probably may distort everything.
Yeah. John, we also had some inflation data out of China as well. CPI rose just 0.5% in July. That's the slowest pace since January. Core CPI rose only 0.3%. Producer price inflation decelerated as well, down to 3.5%, and that was fell 0.7% month on month. How should we read this? Is the inflationary pulse from the Iran war, is that receding?
Yeah, well, it's part of the same picture, isn't it? It's still the lack of domestic consumption in China, so prices are simply not rising. Again, that's been the case for some years, and China, I think, is well able to absorb the Iran price shock, as it were. Such as it is. I mean, it's already abating in terms of oil prices and so on.
Alex, what should we read into this inflation data? It's moderating clearly, isn't it, in the mainland, both at the consumer level and at the factory gate level?
For the factory gates, I think it is affected by oil. So the retreat in oil price actually is a key factor in that. And for the consumption side, first of all, this is a structural trend. China's domestic consumption remains weak, and the pickup in production actually, I think, only impacted limited amount of people. So that's why we are not seeing a translation from wealth into consumption too much. And then I think another factor we need to consider for this month is the extreme weather. There are so many rainy days, and there are so many hurricanes. So I think there's also a factor affecting the statistics. So that makes things look even worse this time.
Makes it very difficult for central banks to know what to do, doesn't it? Around the world, not just the Fed that we were talking about earlier, but around Asia and everywhere else.
Yeah, right. Yeah, because in this kind of weather, you don't like to go out to consume. So that is another challenging factor to come for them to handle, because I think this would make the consumption even worse, or more reliance on e-commerce.
Let me ask you both about the markets. I mean, John, we got US stocks once again at a fresh record. If anything, the momentum seems to be building again. We've got, it was the best week since April last week. The NASDAQ jumped over 5% over the week. Why are we seeing US stocks just going from record highs to record highs? And it seems to be everything in the tech sector's rallying at the moment. Chip stocks, the AI related stocks, all seem to be going up at the moment.
Yeah, well, there's actually a lot of rotation going on under the surface, but it's just on balance, just enough to keep the broader indexes moving ahead, albeit somewhat slowly. My view is, so we saw that massive rotation out of or massive sell-off in semiconductors in particular, and some other tech hardware. in June, July, but that sort of initial sharp break has now turned into a bit of a rally. The rally will probably try to retest the highs or retrace quite a portion of the fall. But personally, I'm skeptical. I think the price bubble of the stocks, the semiconductor stocks, is now bursting. But meanwhile, there are plenty of other sectors which are the beneficiaries of AI. The banking sector, in particular, has been pointed out as profitability and so on of the major banks is going is growing very well. So those sectors have been supported. So I think on balance, we're going to see. We're going to continue to see the markets edge ahead, but the possibility of a sharp downturn in the tech sector as a whole cannot be ruled out.
Alex, what do you think? We had this big bounce in the semiconductor, the iShares semiconductor ETF, up more than 7% last week. So tech stocks seem to be seeing a big rotation back. What do you think? This is sustainable?
I think it's just enter into a very broad consolidation. It is very difficult to revisit the high because the sell-off factor is very sharp and very deep. So I think it's very difficult for them to fully recover. But people giving up of stock selections, I think they just pick the board index. I think for the retail investors, they just believe more and more in indexing. So that's why the whole market actually is super strong. So that fund flow actually is supportive. But the problem is we are getting higher bond yields, and actually that would be negative for corporates. But one thing I would point out is the surprisingly strong gold performance last week. So probably that means that people are a little bit easing on the concern on the rate hike. So that I think is another factor probably supporting the market.
Is China is buying a lot of gold at the moment, isn't it? Is that supporting the market?
Yeah, China is buying a lot of gold. That's supportive for the gold, and I think gold actually is also reflecting the interest rate expectation in the long term these days. So the strong gold performance actually is also a little bit supportive for the market, and of course it's bringing up the mining sectors as well.
And what about South Korea, one of our favourite markets? I don't know whether the Kospi follows the S&P 500 or whether the S&P 500 is following the Kospi, but given we've now got this bounce in semiconductor shares, what does this mean for South Korea? Because the Kospi is down 31% now from its June high. It's trading on a PE of just over 5. Do we see a rebound there as well?
We may see a short-term rebound, but I think, again, the same thing applies. I mean, the Kospi is, I can't remember exact percentages, but just those two stocks, Samsung Electronics and SK Hynix, I think nearly half the index or something like that. So whatever happens to those is what the broader index is going to do, I think, to a great extent. So again, I see that being volatile and at least some sort of ongoing correction for quite a while before we can absorb the the extreme overvaluation of those stocks in particular.
And finally, Alex, just some quick thoughts on the Hong Kong market and Chinese markets overall. Mainland markets seem to be doing okay, don't they? But Hong Kong's still rather lackluster.
It's because last week we got the taxing issue on insurance here. So that's dampening the confidence on the local shares, including insurance, banks, and properties. I think that the impact actually was accelerated. The impact may not be too much in the long term. So we probably will see stabilization in those sectors. And for the platform, I think we probably may not be too strong. Actually, Chinese investors are selling out. And we probably may see a rebound in chip stocks. But overall, I think the tone is improving. And I think we probably may just stabilize above 25,000 and trying to move higher later on. So the momentum actually would be less because Hong Kong actually has been a beneficiary of fund flows last month. So that may be gone because sentiment elsewhere are improving. So Hong Kong momentum actually will be less, but overall picture I think is improving.
Okay. Well, look, thank you both very much. We've run out of time, but great to hear your thoughts and have a good week. You heard there Alex Wong, who is director at Alex K.Y. Wong Asset Management, and John Schofield, who is managing director at Tempus Investment. It's time for our regular view from mainland China. I'm joined this morning by Shanghai-based independent economist Andy Sher. Morning, Andy.
Good morning, Peter.
I wanted to get your thoughts on the trade data that came out at the end of last week. China's exports surged 24% year on year, second consecutive month of 20% growth. It seems, Andy, almost every sector now, China runs a trade surplus in. Maybe not in chips and computers, but it's catching up fast there as well because exports of semiconductors soared 117% as well. I mean, is this good for China to have such a dominant trade position now globally?
Well, I think that China is obviously very competitive. It's got scale, it's got depth. I think the driver for what's going on is the AI boom or bubble. So much money has been poured into AI centers. Apart from these logic chips, so-called AI chips made in Taiwan, most other stuff made in China. So I think this is really the biggest part of this massive increase. EV is something else that's also happening, the hot weather in Europe also has increased Chinese exports of like air conditioners and so forth. So many things have come together to make exports perform like that. But no.
The trade surplus is going to be, well, for January to July, it's going to be $687 billion, which means if it carries on at that pace, it's going to be even bigger than last year. It's going to be over $1 trillion, clearly. I'm just wondering, I mean, this is obviously great for China's economy, the boost it gives to China's economy, but I'm wondering what it means for global trade, because, normally you trade your comparative advantage. I'm good at making product A, so I'll sell that to you. You're good at making product B, and I'll buy that from you, and therefore both sides benefit. But when you have one country, whichever that country is so dominant now in absolutely everything, in every sector, almost now China has a trade surplus. Does that start to distort global trade or cause problems for the trading system?
Well, I think that if the other side does have trouble paying, obviously this phenomenon cannot last. I think the East Asian phenomenon of high savings rate, large trade surplus has been going on for a long time. So in terms of percentage of GDP. Actually, China is not at the place like Taiwan or Japan had before. So there is an issue here in terms of East-West imbalance. What China will not do is to do what Japan did. Is eventually they increased currency to a very high level, which did not decrease trade deficit, but eventually caused tons of other problems. And it did decrease Japan's trade deficit by moving its industries to other countries. So it's basically moving trade surplus to other countries. But its high currency causes a lot of damage to Japan. So I expect like the West at some point to come together to ask China to appreciate the currency, which at some point maybe China will do, but certainly not now. So I think that the world has to wait for this phenomenon to peter out on its own. And if you have a problem with China, you don't have to buy.
But the currency is another issue, isn't it? That presumably is going to cause friction with other countries in the world. Because if it was a fully functioning market, a normal market, the Chinese yuan will be appreciating for sure with these types of trade surpluses and current account surpluses. But obviously, it's a managed currency, so that means that it's not allowed to appreciate to maybe the levels it would, which would then naturally reduce some of those trade surpluses. Is that going to be a problem? Do you see China coming under pressure there?
Yeah, it's possible, but the issue is that China is an independent country, not like Japan. Japan's property bubble burst in 1992, and it let the currency value double, which was crazy when your economy is in trouble and you double your currency value. So, the problems that Japan's facing today, why Japan has faded away, has a lot to do with the bad decision that happened then. But China will not do it. It's, if Europe doesn't want to buy stuff from China, go ahead. Europe has increased tariffs on EVs quite a lot. So if they want to stop buying Chinese air conditioners, it's their choice. So I think that's what China's policy will be. Let it be. And if you don't like it, you don't have to buy.
I'm wondering also how much of this is down to prices increasing, because we're seeing huge increases in things like the prices of semiconductors, whereas if you do measure the trade on a volume basis, then the increase is much slower. So is this partly due to the inflation?
Yeah, it's all driven by AI. I have visited many company factories in the past month. About 1/3 of factories have seen a tremendous increase in prices, mainly driven by AI, either on the cost side or on the revenue side. On the cost side, even like in like small PCB boards, kind of stuff that real commodity, really cheap, but the price is spiking up because there's so much demand from AI. So I don't know how to deduct these. It could be 5%. You can deduct 5 percentage points, maybe even a bit more. And it's all funded by the U.S. AI spending. They have borrowed 1.6 trillion US dollars now to invest in those AI data centers.
So we saw data over the weekend on inflation that seems to be moderating certainly in July anyway, doesn't it? The CPI rose just 0.5%. We saw the PPI decelerate as well. Is that going to maybe therefore naturally reduce some of the trade surplus? Are we seeing signs that inflation is easing again?
Well, I think that it's not as much deflation as a couple of years ago, but China does not have significant inflation. We the retail side we see that dining out has really improved, but it's partly driven by the discounts. Local governments are all encouraging restaurants to discount, so that has really boosted the retail sector. But there isn't inflationary pressure. China's productivity is gaining tremendously, and the on the other side is that the property sector has cooled. It's continued to cool, and the household sector does not have a strong incentive to go out and spend a lot of money.
Are there concerns? Do you have concerns about whether or not there's a sort of K-shaped economy developing here, where certain sectors, if you work in them, you're doing quite well, but in other sectors, you're not really feeling the benefit. I hear, we hear a lot about domestic demand remaining weak, but then when I speak to people up on the mainland, they tell me, actually things look pretty good in places like Shanghai and Beijing. Consumers are going out shopping, restaurants are full, people are traveling. What are you seeing there?
Well, the domestic travel tourism has been rising rapidly for a long time. So that is a bright spot. And then the automobile, the electric vehicle was bright spot. But this year is the auto sales are down substantially. So only the sector is supported by the rising export. So the overall, the sector is not growing. So this is a kind of a weakness in the economy, in the auto sector. In terms of the K-shaped economy, Chinese strategy is to keep everything cheap so that the people with average income can afford a decent living standard. This is why Chinese people are content. The key reason is that there is no inflation. And the in terms of pay labor compensation, the inequality is not so large. So that's the key to Chinese stability. In terms of growth upside, it's it's really driven by a few sectors that with lots of innovation or exports fueled by the U.S. Asset market boom, AI, printing money. Doesn't matter. There is upside from somewhere, but the upside is shared across the economy through competition. So this sector does not make all the money. Okay, so this Chinese society is stable because of low prices.
And what about the AI sector? You've mentioned earlier on that's an area of growth. I mean, we're seeing this sort of rush of new AI models coming from all sorts of companies, Alibaba, Moonshot, ByteDance, all releasing new AI models that when you read about the testing seems to be, up and fairly close to some of the best AI models in the US, but at a fraction of the price, much, much cheaper. Is China catching up with the US in the AI race?
Well, I think China is popping popping the perception of AI is so advanced, so powerful. That kind of a story. What China is showing that the AI is not so complicated. This model is not so easy, it's so hard to make, and does not require trillions of dollars of worth of chips. So basically, the AI story bubble is over. It's how it's going to be reflected in the financial market, and it takes some time. I don't think it's years away. AI bubble can last for many more years. The AI bubble will pop in a few months, in my view. So that's what China has done. And and AI companies are not going to make a lot of money because even if AI is very useful, competition will determine its value. It doesn't. When you make something useful, doesn't mean you make a lot of money. If other people can all do it, so you don't make money. So that's the situation with AI. So Chinese AI shops certainly are not going to make a lot of money. There is so much competition, and the U.S. AI is subject to the same competition. OpenAI just cut its AI service on its model Luna by 80%. So that's the China story. Price war. Everything in China is a price war. That's why it's good, because it means that the capitalists don't make a lot of money. Okay, and the productivity benefits go to the people through lower prices. So that's the kind of what we are seeing. That's the key takeaway story. And in terms of the impact on the economy, we do see that applications of AI in certain areas that can improve productivity, but not a lot yet. You look at the automobile, this AI interface. So it makes it more convenient for you to communicate with a car, but it doesn't really revolutionize driving. It's not like you're driving so differently, right? And Shanghai's container port now is using AI to manage traffic because at a container port, traffic is kind of looks similar, but actually is different every day. Okay, so it's a kind of chaos, structure chaos. So you use AI, you actually can improve the productivity somewhat. But is that a lot? Is that a lot? Is it kind of a double the productivity? It's not really that. It's a few percentage points. So it's a good thing.
Now, you mentioned there, you said capitalists don't make a lot of money. Is that one of the things that's behind this surprise tax that China announced last week on offshore trusts? People have been given just 90 days, basically, to declare and pay tax on assets moved into trusts. Going back several years, it also impacted the insurance sector in Hong Kong last week because there was a fear that this will also apply to insurance policies taken out by wealthy Chinese in Hong Kong. What's behind this? What is the thinking behind this that explains why China is suddenly doing this?
Well, China is, the local governments have been under kind of a fiscal pressure for some times because that a property sector is down. Local governments used to get half of their revenue from land sales. And that part is really low now. So there's a lot of pressure to increase revenue. That's something that that's one of the reasons that they are looking for areas to raise revenue. But in terms of what's going on with the trust, I think that the Chinese government is worried about Chinese assets moved into offshore trust and beyond the control of the government. There's a fiscal side is one issue, but control is really important. Chinese government does not want to lose control. So the offshore trusts with the Chinese assets inside must be controlled by the Chinese government. How they do it, we don't know. But what the Chinese government does that they test various measures. But anyway, what happens in China stays in China. If you think that because you know some clever bankers who can restructure your stuff, then somehow you're somewhere else, like in other countries. It's highly unlikely.
So is China moving towards a taxation system more like the US, actually, where wherever you are, if you're an American citizen, wherever you are in the world, you can have moved out of the US, live somewhere else for a long time, being paid taxes over there, you are still going to be subject to tax. Is that the system that China's moving to, this sort of system of global taxation?
Oh, China does have global taxation, but it didn't implement it. On paper, China has the same system as the U.S., but it didn't implement it. So what's going on is really kind of catching up with the people. A lot of people didn't believe China would implement the global tax. But I think that now certainly China didn't have the capability in the past to enforce it offshore. Now China does have more and more power vis-a-vis other offshore financial centers like Hong Kong, Singapore, or probably over time London and Switzerland.
That's Shanghai-based independent economist Andy Scher.
You're listening to Peter Lewis's Money Talk. Money Talk.
And thank you for listening this morning. Do please take a look at my daily newsletter. You'll find that at peterlewismoneytalk.substack.com. On Tuesday's show, my guests will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Peter Kim, Head of Global Investment Strategy at KB Financial Group in Seoul, and in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Woods. See you tomorrow.
Money Talk